In this explainer, we are diving deep into a process that is absolutely essential for any company with overseas operations. We're talking about translating foreign subsidiary financials for consolidation, and we're going to use AASB 121 as our guide. Now, if you're an aspiring accountant or auditor, this is a skill you have got to master.
So let's kick things off with a very common problem, one that every single multinational group has to solve. You've got your parent company reporting in, say, Australian dollars, but your subsidiary is over in New Zealand reporting in New Zealand dollars. How on earth do you create a single, coherent picture of the whole group's finances?
Well, the core issue is pretty straightforward, right? You can't just take the numbers and add them together. It's completely meaningless. It would be like adding apples and oranges, and that is the exact opposite of what good financial reporting is all about.
And this is where the accounting standards come to the rescue. The whole process is laid out for us in AASB 121, the effects of changes in foreign exchange rates. This standard gives us the precise, mandatory roadmap we have to follow.
Okay, so here's our game plan. We'll start with exactly why translation is so important. Then we'll get our definition straight, the key currencies you have to know. After that, we'll walk through the actual translation rules, look at a critical management judgment, apply it all to a case study, and then finish up with that final accounting entry that brings it all together.
So first things first, let's really hammer home why this whole process is mandatory. This isn't just some box-ticking exercise. It's absolutely fundamental to presenting a true and fair view of the group and protecting financial integrity.
You see, consolidation is all about presenting the parent company and all its subsidiaries as if they were one single economic entity. And to do that, you need a common denominator. In accounting, that common language is a single currency. It's really that simple. Without translation, proper consolidation is just impossible.
Now, to really get a handle on the rules, we first have to speak the language of the standard. AASB 121 is super specific about the different types of currencies, and nailing these definitions is the absolute first step to getting this right.
All right, this one's the easy one. The local currency is exactly what it sounds like. It's the currency of the country where the subsidiary is physically located. So a subsidiary in the UK, its local currency is the British pound. Simple.
Okay, now for a really critical concept, the functional currency. This is all about the economic substance of where the subsidiary does its business, not just its address. And here's the key part. It is not always the same as the local currency. Figuring this out, as we'll see, takes some serious judgment. And finally, bringing it all home is the presentation currency. This is simply the currency that the final consolidated financial statements are going to be presented in. So for an Australian parent company, you can bet this is almost always going to be Australian dollars.
All right, now for the fun part, the core mechanics. You're going to want to pay close attention here, especially for any exams. We're about to break down exactly which exchange rates you need to apply to which parts of the financial statements.
So, for the income statement, think sales, cost of sales, all your expenses. The main principle is to use the exchange rate from the exact day the transaction happened. But can you imagine trying to do that for every single sale? So the standard gives us a practical shortcut. We can use an average rate for the period, but there's a huge warning label here. If exchange rates are jumping all over the place, that average rate is no longer a fair representation, and you can't use it.
Now the balance sheet, this is where it gets a little more interesting. It's not a one-size-fits-all approach. We have to separate the items. For monetary items, things like cash, accounts receivable, loans, we use the closing rate, so the spot rate at the end of the reporting period. But for non-monetary items like property, plant, and equipment, the treatment is totally different. This distinction is absolutely critical. And here it is. This table is your exam cheat sheet. If you're translating from the functional to the presentation currency, here are the rules you live by. Assets and liabilities, closing rate. Income and expenses, average rate. Share capital, the historical rate from when it was acquired. Now, because we're using all these different rates, things won't balance. And that difference, it does not go to the income statement. Instead, it gets parked in a special equity account called the Foreign Currency Translation Reserve. You have got to remember this table.
So, we've got the rules down right, but applying them correctly hinges on one single critical decision that management has to make right at the start. What is the subsidiary's functional currency?
And this quote from the standard is so important because it just goes to show you that accounting isn't always black and white. It requires professional judgment. Management has to analyze the subsidiary's entire economic environment to make this call, and you can be absolutely sure that auditors are going to look at this decision very, very closely. So how do they make this judgment call? Well, this slide shows you the two ends of the spectrum. On one side, you have a subsidiary that's basically a standalone business. It operates independently in its local market. In that case, its functional currency is its local currency. But on the other side, you might have a subsidiary that's really just an extension of the parent. It's totally reliant on it. In that case, its functional currency is probably going to be the parent's currency. The key question is always, how much autonomy does it have?
Okay, enough theory. Let's apply all these concepts to a practical example. Let's say we have Kiwi Ltd, a parent company in New Zealand, and they've just acquired Bulldog plc, a subsidiary based in the UK.
Okay, let's get the facts straight. Bulldog's local currency, because it's in the UK, is British pounds. But because it's so dependent on its parent company, management has decided its functional currency is the New Zealand dollar. And for the group's consolidated accounts, the presentation currency is also the New Zealand dollar. So we're going to translate Bulldog's pound-denominated accounts directly to the presentation currency.
Let's start with an income statement item, sales. Bulldog had sales of £2.5 million. We apply the rule we just learned and translate this using the average exchange rate for the period, which we'll say is 3.10. That gives us translated sales of 7.75 million New Zealand dollars. Easy?
Now let's grab a balance sheet asset. Bulldog's plant and equipment is on the books for £950,000. We apply our balance sheet rule, which means we use the closing rate at the reporting date. Let's say that's 3.20. That gives us a translated value of 3.04 million New Zealand dollars.
Okay, so imagine we've done this for every single line item, using closing rates for assets and liabilities, the average rate for income and expenses, and historical rates for equity. What's the problem? Well, the translated balance sheet isn't going to balance. So how do we fix it?
And here is the final beautiful piece of the puzzle. That difference that pops out isn't a trading profit or loss, it's purely because of exchange rate movements. Because of that, it completely bypasses the income statement and gets posted directly to that special part of equity we mentioned, the foreign currency translation reserve. This is the final entry that makes the entire translated set of accounts balance perfectly.
And that leaves us with one last, really critical thought to take away. This accounting entry has very real-world consequences. A big swing in exchange rates can create a massive change in that translation reserve. That directly hits a company's total equity, its net asset position, all without the subsidiary's actual business changing one bit. And that right there is why understanding how this reserve works is non-negotiable for any serious financial analyst.